Hello and welcome back, everyone. Welcome to today's panel on crypto. I hope you are as excited as I am about this panel. This panel will explore the accelerating institutional adoption of crypto and blockchain, the impact of increasing regulatory clarity, the emergence of new applications, and the opportunities and challenges for investors. So if you're new to crypto, or if you are accelerating your adoption of crypto, this panel is for you. So my name is Alyse Sue, co-founder of Transhuman Coin. We are a decentralized science token, or DeSci for short, and we're going to be on a reality TV show called Killer Whales. It's Shark Tank for crypto startups, so check us out. We're going to be on Amazon Prime and Apple TV next month. Now, so to our panelists and today's topic, first we'll like to cover institutional adoption. So, how has the perception and adoption of crypto assets changed among institutional investors in recent years, and what's driving this shift? Now, I'll ask my panelists to also briefly introduce yourselves before you answer the first question. And I'll probably get Ryan, you to start, given that you've worked at major asset management firms like BlackRock.
Sure, thank you. Ryan McMillin, co-founder and chief investment officer at Merkle Tree Capital. We're a high conviction, long only crypto fund. The last year has been really good for that institutional change of mind, and that's really been spurred by the launch of Bitcoin ETFs, particularly a BlackRock ETF, which gives investors a real lot of confidence that a big name is backing the sector. And before that, there was only a handful of investors like Tesla who would put Bitcoin on the balance sheet, and that got some positive and negative press as well. And another thing that's happened, that had kept corporates out of investing in the space really was some accounting rules. So they changed late last year as well. So it's now a lot more attractive for corporates to be able to hold Bitcoin on their balance sheet. And you're also seeing sovereign wealth funds like Abu Dhabi also taking positions in the Bitcoin ETFs, and 13F filings show thousands of institutional investors now taking a position in Bitcoin ETFs. So yeah, that's been the real big unlock.
Hey guys, Ed Carroll. I run a firm called MHC Digital Group. We're an investment bank for digital assets. I'll just add to what Ryan was saying. I think that 2024 was pretty transformational for digital assets. I think there's been increasing regulatory clarity. I know we'll touch on that in a little bit, but I think what that really did was it did unlock the opportunity for institutions to start to allocate quite aggressively. Our view is that allocation still has a long way to go, particularly as we find the regulation becomes a bit more nuanced, and the ability for investors to get more comfort around their allocations and what that looks like becomes a bit more clear. I'd also add that various other applications of blockchain technology in general, specifically as it relates to sort of stable coins, the use of blockchain for tokenization and various real-world asset applications for the technology, I think all of those things are getting a lot of traction with the banks, and as a result, other institutions are looking at them as well. So I think 2024 was a very, very big shift in the mindset for the sector and for the technology, and it's only just getting started.
Yeah, thanks. Hey, it's Pratik from Apollo Crypto. We run 3 crypto funds across different strategies: delta neutral, long only, and some other strategies. After 2024 and the launch of the ETFs, I think institutional adoptions has gone up and to the right, and I think it's just the beginning. There's one thing about launching ETFs, but after that, we've seen a deep options market and other derivatives market come online as well. And a lot of institutions that were originally not able to invest in this asset class can now not only invest via ETFs, but they're also doing all types of different strategies, such as the CME basis trade and taking long and short sort of views via options. We're also seeing a lot of corporates, such as MicroStrategy, buying billions of dollars, and they're not alone. We are seeing corporates buying Bitcoin as part of their treasury strategy. There's MetaPlanet in Japan. There's a firm out of Hong Kong. There's several of them in the US. So we're seeing a lot of that, this diversification of the treasury happening as well with Bitcoin as a core part of the asset base in the treasury. Aside from just treasury bills and bonds haven't done that well, or gold or just currency, I think Bitcoin's actually also forming a place in that, and pension funds are also looking at it that way now.
So we've talked about corporate adoption such as Tesla and a MicroStrategy, now called Strategy, who've put crypto on their balance sheet. Now, what about the regulatory side of things? So obviously when institutions are looking at crypto adoption, there's lots to consider in terms of the reg side. So how is the regulatory landscape evolving for crypto, especially in relation to family office, high net worth, and corporate adoption? And what impact will this have on our industry? Are we moving towards a more standardized and accepted framework? Now, I'd like to direct this firstly to Edward. Given your experience in licensing and regulatory engagement, and feel free to talk more about what your firm does.
Sure. So what I would say is that the answer is yes, we are moving to a more coherent sort of framework globally. I'm based in Singapore, but we've looked at regulatory frameworks across the Middle East, Asia, certainly Australia. In Australia here we have a fully fledged wholesale AFSL across the spectrum, so we can look at those derivative products we're talking about before as well, alongside a bunch of other products. But then you look at what's going on with the kind of crypto task force in the US, the EU. I think there is a concerted effort globally to support this asset class. And I guess what that means, to answer the other part of your question relating to the kind of more sophisticated allocators to the sector, being the family offices all the way up to the institutions, is that that gives a lot more comfort around allocating at scale. I think the framework itself is a little bit more nuanced than just saying we're going to regulate crypto. I think that you have to be a little bit more, I don't know who was here for my talk earlier, but we do think about crypto as being a kind of multifaceted asset class or technology solution. So, I mean, like you've got regulation for blockchain as a technology solution for like tokenization. You've got specifically stablecoin regulation we think will be carved out individually, and it's very important that is a kind of globally a global standard so that stablecoins can be used for cross-border payments and other necessary use cases. And then I think regulating the more esoteric tokens, the bitcoins all the way down to Ethereum and then more altcoin, meme coin, NFTs, that's a separate framework in and of itself. But I think the overall theme is very, very strongly in favour of regulatory support, which should facilitate that adoption we want to see.
Any thoughts to add, Ryan? Do you agree?
Yeah, I think it's been really hard for fiduciaries to allocate in size to the space without that regulatory certainty. So that really has kept pension funds and the like out of the space so far. And to get that regulatory certainty, you need political will to create the legislation. And we've only just seen that the last election in the US really did bring crypto to the forefront, and there were voters and there were blocks and there were a lot of support for the crypto sector there. And we're hopeful we'll see something similar here in Australia, where we hope to see some crypto policy by both parties soon with an upcoming election. And that's really where it has to come from, that top down to get through to everybody else.
What do you think, Pratik?
Yeah, I think it couldn't be more bullish in terms of regulatory, on the regulatory front. We had a very hostile SEC in the US. They were basically harassing crypto founders, businesses. They were debanking them. It was pretty severe, pretty bad. Nobody could build anything in the US. Now with Trump and his executive orders and the AI and crypto czar David Sachs, they have a timeline to produce a favorable, somewhat of crypto framework in the US. We should be hearing something in 180 days to 360 days, and optimistic that we will get some pretty clear direction from the US, and the rest of the world will follow. The G7, G20 countries should follow what the US does. So it's never been better on the regulatory front since the inception, since Bitcoin started.
I agree. These are exciting times in terms of the reg side of things, especially with a major country like the US looking at putting Bitcoin in treasury. So that's a pretty good segue into investment strategies and performance. what do the investment strategies look like for crypto, and what are the key factors driving successful crypto investments? Are there specific sectors or types of digital assets that are particularly attractive right now? Pratik, I might get you to start with this, given that Apollo Crypto is one of the best performing funds.
Yeah, thanks, Alyse. Crypto investing is more of an art at this point in time. In traditional finance, all of you are used to cash flows, and you could do your GCF analysis, you could do PE, PF ratios, you can do all of those things. In crypto, you can't do that. In crypto, by nature, it is a decentralized blockchain system which is powered by its own currency. So you can imagine it like if you're operating in Australia, you need the Aussie dollar. If you're operating in the US, you need the US dollar. Britain, you need the British pound. And you need to operate on a blockchain using its own currency. However, these currencies are not sovereign currencies. They are currencies that power the blockchain because it's a decentralized network. And in order to use the services of the blockchain, you need to buy that currency. So that's sort of like the core of why any of these coins exist and why people purchase them. It's because if you want to use the service, you got to use the coin, you got to buy the coin to transact in that currency, to do things such as DeFi or any other things you want to do, even stablecoin transfers. So when we look at it from an investment strategy perspective, we can monitor this stuff. Like blockchains don't lie. Blockchains get updated practically every 10 seconds or every 10 minutes. In the case of Bitcoin, they don't lie. It's all transparent. We can very easily track in real time whether or not a blockchain is being used in terms of the daily active users, the number of transactions being done, the amount of gas that is being spent, gas being the currency in several different blockchains. And we can devise an investment strategy looking at all of these on-chain metrics in real time and getting a pulse of the network of the entire thing. So we have some real-time feeds, we monitor that, and we can then backtest it and determine, it looks like this economy is growing, so to speak, because you're seeing the flow of money and the flow of stable coins and the flow of transactions happening on-chain. And so we would then obviously have a view and a thesis for the year, and then we adjust it month on month, quarter on quarter, depending on what we're seeing in the market. And then we backtest it with obviously what is actually happening on-chain. So very easy to see, like, daily active users on Solana was spiking last year, has come down now. A lot of that is flowing to a new blockchain called Sonic. Things like that, we could track that and then make our investment decisions as such.
Ryan, what are your thoughts?
Yeah, I think in terms of investment strategies, it's best to have a strategy. A lot of people invest in the space without a strategy, and that's the major pitfall. So it's sort of like a meme that people buy the top and sell the bottom, but the data does show that that's exactly what happens. And the best thing you can do is buy and hold or dollar cost in, and that's probably the best strategy for most people. We look at adoption rates on chain and use that. Are there more transactions happening here? Is there more wallets here? Where's the activity? And that sort of gives you an indication of where they're going. And then if you can understand what type of activity is happening there, they're the blockchains we're sort of attracted to. And also understanding the cycles as well. To date, there's been pretty strong 4-year cycles. We think they might start to get weaker and weaker, but to date, they've been there. And certain periods of time, you'll see Bitcoin outperforming, and other periods, you'll see altcoins outperforming. So we try to be really observant of those cycles and try and maximize returns for our customers, for our investors, by getting as much out of that knowledge as we can.
Yeah, I'd just say that I think that, kind of to Pratik's point, the fundamentals of investing in this sector are very different, and it depends on what you're investing in the sector. But I think the thing I struggled to reconcile early days was how you could possibly have the token be representative of the actual value of the ecosystem it represents. So that's and that's because, like, my background's traditional private equity, so I was looking at it with metrics and with a hat on, which is a little bit more traditional. But it kind of requires, I think the point being, it requires that you look at things in a slightly different way to see, to kind of get a feel for value and get a feel for what the world perceives to be value. The one thing I would say as a carve out to that thesis is that I think that Bitcoin has kind of, in the last 12 months, established itself as on an island in terms of the way that you look at allocation towards it and necessarily the way you value it. I think that it's a little bit more vanilla in that it has a fixed supply curve, the demand as a kind of inflation hedge, or necessarily, as it basically its use case as a corporate treasury hedging mechanism or otherwise. That kind of thesis has carved out as a standalone, partly because there's been more support for it, firstly through the ETFs and then through the kind of regulation that's coming afterwards. But I think that overall, it's just a different way to think about investing, looking at this sector. And so that's why it's actually very important that you either do a lot of work yourself or you allocate through someone you trust, because it really is quite nuanced and very different to any other asset class I've ever seen.
This was alluded to before on the panel, and it's about looking beyond just Bitcoin and Ethereum. There are many other different layers of the technology out there. There's different types of tokens for different use cases. So my next question to the panelists is, beyond Bitcoin and Ethereum, what other crypto assets or blockchain applications are gaining traction and showing promise for long-term growth? For example, have you considered DeFi or decentralized finance, NFTs, Web3 or Layer 2 solutions? What excites you?
I can start. I think DeFi has the most compelling use case. It was in 2017-18, and it's probably the most compelling use case right now. I worked in traditional banks and consulting and stuff for a decade, and it is absolutely ridiculous and ludicrous on the amount of IT and security and resiliency and middle back office accounting audit tasks that goes into it. It's like 80% of all the friction that happens in the organization in large banks at the moment. This can all just be very simply replaced with atomic transactions and swaps on the blockchain. Stablecoin transfers, like, think about it. Today, if I've got a CBA share, if I've got 10 and I want to give 10 to you, on your birthday, I sort of can't. It's sort of practically impossible for me to do that. Where we are heading right now with DeFi and tokenization is I should be able to transfer it to you like a WhatsApp message. In 5 or 10 years, hopefully we're in a world where, I want to transfer 10 stocks to you. Here's like a WhatsApp message. I just send it to you and it's in your account. And it happens in 5 seconds. That should be possible, but it's not today because of this really heavy friction-filled financial system built on COBOL databases from like the 1980s. So I think the future is where we're heading into stablecoins and atomic swaps and transactions and stuff. And once you do that, you should be able to then use DeFi to its full extent and be capital efficient. So if you've got allocation in, for example, the Apollo Fund, say you've got $1 million with us, right now that money is just deployed and it's locked until you redeem. We are heading towards a future where you can give us $1 million and there will be lenders on chain in DeFi, and you should be able to redraw $500,000 by pledging it as collateral. And that should happen within a minute, like WhatsApp messages, within a minute or 5 minutes. So that's the future, and I think that's being built in the next 5-10 years. And very optimistic about that. I'm
excited. Edward, what do you think?
I'll be a little bit more vanilla. I think stablecoins, but more sort of basic applications of stablecoins not related to DeFi, I think is the near-term future for the technology. I think that stablecoins have an enormous place in the world to disrupt traditional cross-border payment services. We firmly believe that there's going to end up being an on-chain FX market which will strip out a significant amount of the costs in the system to move money around, and that will then facilitate significantly more additional sort of derivative products and services which can all happen on-chain, which kind of then leads into your DeFi solutions that was just discussed. But I think that the logical place to start right now is things that are relatively well understood and applicable to the real world, because that's where the regulation is going to start, that's where the institutions are going to understand, that's where the banks are going to support. And so I think that stablecoins is the logical place to do that. And we actually are the partner of Circle in Australia, the largest regulated stablecoin company in the world. We announced a partnership with them in November last year to help facilitate that kind of adoption of stablecoins, because we firmly believe that that has a really strong place in the existing financial ecosystem.
Yeah, I think stablecoins are going to be really super powerful. There's also obviously gaming, there's NFTs, there's decentralized physical infrastructure networks, so that's actual telecommunications networks built on chain. So there's so many different ways we can go here. DeFi has been a pretty solid performer, and you just want to see activity wherever the activity is. That's often where it is. We also really like Solana as well. The ability, it's the fastest blockchain of the majors, capable of up to 1 million transactions per second. So that in the future, we think will replace something like the NASDAQ, where you can then trade Apple shares with somebody, you can custody them in your wallet, and there's no other chain at the moment that's capable of doing that.
I just also add, I think that one of the critical things that regulators have struggled to get their head around, and I think it's part of the reason there's a lot of reluctance in general to the token economy, is that what kind of happened with the evolution of tokens as either, whether they be like an ecosystem, a utility token for an ecosystem, or effectively functioning as a quasi-equity piece for certain projects as well, is that it kind of removed the protections for retail investors that typical public market products have. And so until the regulators figure out a way, like, I totally agree with you that people should be able to move their shares one to another, and it should be it should be a lot more efficient. It doesn't need to be intermediated all the time. But the problem is that at the end of the day, when people start losing money, they're going to blame someone. And so it's very important that there is some protections in place for retail investors to prevent that. That's a very non-crypto kind of mindset, by the way. It's very much about disintermediation in this sector. It's about freedom of choice. It's about being able to do things and use the technology for the best, for the benefit of however anyone wants. But the problem is that what happens is that people then pile into things they don't understand, and then they get caught losing money, and then they blame someone. And so I think, like, until that problem is solved, it's not really clear to me. I mean, maybe you guys have got a view on this, but it's not really clear to me how that problem is going to be solved to provide necessary protections for retail investors to ensure that they are protected in the event that they get access to things they otherwise wouldn't be able to see.
No, that's right. Is there going to be a walled garden and a casino, potentially, right?
Yeah, I mean, some products are being built right now which are using biometrics like a Face ID. And so everything is sort of KYC'd. So when you transact, for example, I send you 10 CBA shares, my Face ID, your Face ID, and then it's sort of recognized and KYC'd. And those type of things are being built, but then there's concerns about privacy and stuff. So it's all going to get worked through, I think, over the next few years.
I think you already kind of started to touch on my next question, which is around the risk and challenges. So in addition to what you already just mentioned, are there any other additional risks and challenges still facing the crypto industry? And how can investors and companies mitigate these? And maybe just focus on one big one that you think that people in this room should know about.
I'll echo what Ed said. Right now in crypto, it's still pretty easy to get hacked and rugged, as they say in crypto. So you would accidentally sign a transaction, and the transaction has malicious code behind it, and then before you know, all your money's gone. And because crypto is irreversible, once the money's gone, it's gone. There's no customer support or banking hotline that you can call to freeze the assets or recover it. That's the nature of crypto as a decentralized currency. I mean, it was built because it has to be outside the system. I think regulations are coming in to put in place things with real-time risk and fraud monitoring. Insurance is sort of coming in, so those things are being built. They aren't there today. But that's still the biggest risk. So there's an education aspect to it as well as usability. So the Face ID thing that I was talking about, a lot of the crypto people were anti it originally, but I think we're finding a balance between, mild amounts of KYC with Face ID and freedom of transfer of assets and so on. So it's still the biggest risk, I think, is education and not getting hacked at the moment. So there's some work to be done over there.
Yeah, I think it all really comes back to regulation at the end of the day, just having a clean slate and a common base for everybody to work from. It's not going to stop all of the scams. Their scams exist everywhere. But hopefully it does there's still a lot of, not particularly great projects in the top 20 market cap of crypto. And they don't have a lot of users. They don't have a lot of activity. It's not entirely clear what they're doing there, but they're great marketing machines, and people are still buying them without really understanding what they are. So I think education is also a big part of that too.
I would just say that I think that there's a perception of the risk of the quality of the service providers in the sector from people who are not in the sector. At the moment, there are a number of high-quality institutional-grade platforms, custody providers. I mean, like, part of what we're trying to solve in our firm is providing really high-quality institutional-grade trading for crypto, custody for crypto, derivative products for crypto, and then separately funds products as well. But I think that perception that there isn't enough support, like high-quality service providers, still exists. And I think that the best part about this kind of regulatory wave that's coming is that it's going to make a lot of those who are not yet in the sector realise that, one, there actually are some good ones in there, and two, there's going to be a lot more investment into that infrastructure, and hopefully that solves a lot of the security concerns. It helps kind of facilitate the next wave of allocation and the innovation that should happen as a result of that as well.
All excellent points raised. Now, this is the last rapid-fire question to our panellists. Looking ahead, what, in your opinion, is the single most significant development or trend that will shape the future of the crypto industry?
At the moment, I think it's the proliferation of stablecoins. Right now, still moving money is a pain. I think stablecoin is step one. Just like I mentioned, I should be able to transfer Apple stocks to you like a WhatsApp message. Stablecoins are level one of that. Once that gets a framework around it, then we'll move on to the next level, which is stocks. And then eventually private credit, other things will come on chain as well. So I think that's happening and a very exciting thing.
Yeah, I'd have to agree. Stablecoins is the killer app really still for crypto. If you're in Asia, Africa, South America, you can now get your hands on US dollars, a much better store of value than whatever your domestic currency is, and that's super powerful. You can hold it in your wallet. You don't have to go and open a bank account, which you'd never be able to do anyway, and you can hold $10 of US currency.
I agree with you guys, but I'd also add, I think another major one is a Bitcoin reserve for governments. I think that is going to open up an enormous wave of corporate activity to kind of spur additional treasury management using Bitcoin as an additional kind of inflation hedge on balance sheets for those with a lot of cash. And what that will then do is it will facilitate further deepening of the derivative market and the quality of the services provided around that market. And I think as well, personally, that will also lead to a significantly higher Bitcoin price, which is only good for the sector.
I'll actually echo on the strategic Bitcoin reserve a little bit more. So they were talking about in the US, Trump promised it. We may still see it, but the US is also talking about a sovereign wealth fund, which the US doesn't have, like Norway has it, Australia has it. And I am 100% certain that Bitcoin will find its way into that sovereign wealth fund. The reason why is if you do the traditional portfolio management, backtesting Bitcoin, sharp ratios, max drawdowns, all of that, and you fit it into a traditional 60-40 portfolio, even if there's commodities and stuff in that portfolio, the return's always better risk-adjusted returns. So even if the strategic Bitcoin reserve doesn't happen, I'm very optimistic that it'll find its way in the sovereign wealth fund in the US.
There you have it, Bitcoin reserves and stablecoins. Now, we come to the end of our panel. Please thank our panelists.